S&P makes another high. We're going to talk about the next resistance level and what this volume spike means. NASDAQ futures are 10% away from their all-time highs. We're going to discuss the right way to measure breadth of the NASDAQ 100 and what it's telling us right now. Stocks in the S&P above their 20-day moving average is closing in on 90%. We're going to talk about historically what this means and what usually happens within the next 30 days. NASDAQ is currently reading an 80 on the RSI on the weekly chart. This has happened 9 times in the past 10 years. We're going to discuss what it means and what usually happens. We're going to discuss why NVDA and certain AI names are exploding and why others like AMD are forming reversal patterns, and why some of the largest companies in the world look like they're ready to break out, why the Fed is predicting a 75% chance of a rate hike in the next 30 days, and why by December there might be 2 rate cuts. We have a lot to go over, so let's get right into it. Hey everybody, welcome back. Make sure you subscribe to the channel, click all notifications. What we go over is extremely timely and actionable. So you're going to want to make sure that you're subscribed if you're interested in ideas that can actually move the stocks next week and move the stock market next week. Here we are, and this is the S&P futures market. We all know that we had a good week, right? We're not really adding a lot of value by explaining that. What I want to point out here is on this weekly chart, and you can see the slope of this, and you can see the curvature. We can just see that pretty clear. I mean, it's not really rocket science, but what I think is important about this is the ability for us to hold that 200 and then just continually push higher. Now we're starting to break out and people are saying we're overbought. Well, there's right ways and wrong ways to read RSI and overbought. I have a video that I did on it a while ago. I can link it at the... If we take a look here, you could stay overbought for a very long period of time. So just because you're over this is not a signal to sell. Matter of fact, if you use this as a sell signal, I'll leave you with this. It's probably one of the worst decisions you're ever going to make. And you're probably going to miss the largest moves in the stock market. For example, if you take a look how that happened here in December, if you got out because, quote, you're overbought, you're going to have a problem. If you bought here because you're oversold, you're going to have a problem, right? You can see how this came here and how this gave you a perfect, right, reading of a positive divergence on the RSI. And I'm going somewhere with this so that you get it. But before we dig into the real details here, I just want to focus on like these little blips, and they're everywhere. So when you pay attention to them, we actually covered this one on Twitter, but if you pay attention to them, they tell you what's happening. You just have to step back and take a look at it now. The reason I'm showing you this on the weekly is because if you go out to a time frame and you look at the monthly, look at the break right here. And look when you broke, and then look at how it acted over the monthly. While people were saying we're overbought, you would have missed the single greatest move. This denotes where we are on the weekly, but shows long term, you are far from overbought. And you want to be buying ahead of overbought, and you certainly want to stay in there when you're overbought. This monthly overbought going back 10 years, this lasted for 3 years. And all you did was just go higher and just grind higher. Now, you want to watch your oversolds, but understand these overbought periods, they last for years. It's not just a Tuesday, so keep that in mind. Now, the reason to go over that is so that when we look at this daily, you can understand some of the things that are going on here. So when people start seeing this correction or pullback, and I do think we're due for one. I do. I don't know when it's going to happen. I don't know if we go up another 100 points and then have one, but there's one out there. We're going to get into it in a little bit here, but you're at an 80 on the RSI. It is not a reason for you to be getting out of this, but it's a reason for you to be fully aware of where you're at and understand that your moves now are more on the tail end short term than on the beginning end short term. Your long-term investments could still be on the beginning, and I just highlighted why I think that way. But we're trying to figure out what the Fed did, and we're going to talk about it, and it was utterly confusing. But we just have to look at these levels and say, okay, we're just going to start with the basics. 4,500, it's not rocket science. That's what we have to see next week. Are we going to get over that? Are we not going to get over that? Are we going to continue to rotate, which we are doing? And I think that's very important. Now, by rotating, what I mean is we're starting to see who the winners and losers are going to be. You have this breakdown or control bar right here on JP Morgan on the weekly. JP Morgan makes up a very large part of XLF, which is financials. And they've been struggling. But here we are, we test that control bar top and we are unable to break it. but we don't take out the lower low. We don't break this one either. So now maybe this is the control bar. We're starting to form a flag. And now we're closing at a high that we haven't seen for months. We really haven't seen that level of close since here, which would have taken you to February, which gets rid of all the regional bank nonsense that quite frankly never really should have affected JP Morgan since it added earnings to them. Now, we take a look at how we're acting here and we can see very clearly that we're setting up to break out. Very difficult to say that XLF does not look good when JP Morgan's breaking out. But it seems to me that with XLF, and this is the weekly, and this is the 200, and this is your little level right here, no matter how you look at this, if I clone this line, and I always suggest that you clone these, always, so that you can kind of see where they fit in here, right? So I have a pendant. Now, some people will say, well, the pendant's longer than the flagpole. It is what it is, guys. Try not to get hung up on the nuances and just try to see if you can read what's going on with price. So, okay, so let's take a step back now and let's clean all this off and say, all right, well, we're riding that 200-week moving average on XLF, which we've been doing. Why is this time different? I'm not sure that it is yet. What we have to do is we have to watch the neckline right here, right? We've risen before and we've cracked. But we're starting to close over that for the first time, and we're closing over all the regional bank nonsense, which provided a great opportunity for us to buy some of these regional banks, which you're aware of if you've been following along. So now the question is, okay, what do we do here? There's nothing to do right now, frankly. You want to watch this. But what this points to is, why is the market going up when certain sectors are not? Well, rotation, rotation, rotation. You're going to hear me say that a lot this year. Now, XLY, I did a piece on this about a week ago or a week and a half ago. XLY and retail names are at 10-year lows. So XLY retail falls into what is called cyclicals. Think wants versus needs, right? You'll hear me say that a lot. XLY versus XLP, wants versus needs. You might want that new pair of sneakers, but you need Clorox, right? There's a difference. So when the wants start going higher versus the needs, you want to pay attention. For example, what you do is you take XLY, which is wants, retail, discretionary spending, cruise lines, versus your Clorox, your Procter & Gamble, your toothpaste, Colgate, those names, and you look at them on a relative basis. Well, for the past 4 weeks here, we've just been crushing it, and now we're at a pretty critical level in regards to this relationship. Now, we have a lot to cover, so I'm not going to spend a tremendous amount of time on that, but I could do another video on those relationships and how to utilize them. If you're interested in that, just let me know in the comments, and I can show you at least 10 relative charts like that I use to make investment decisions. But I don't know how much that's going to be popular, so just let me know below in the comments if you think that would be helpful. So here we are, and we're breaking out on XLY on the weekly. Well, okay, well, is that Amazon that's doing that? Well, Amazon's the leader of that, right? I mean, I think it's like double digits of that. Well, it doesn't really look like Amazon's what's doing it. We clean this up and we kind of have Wick City up here. We're a little overextended and we're not really breaking out. Well, what's leading us, right? And then you start going through these names and then you start going, well, wait a minute. Walmart looks healthier than Amazon? And it does. Walmart looks healthier than Amazon, technically. It's a no-brainer. Here was your control bar. You flipped your control bar. You fought it, right? So whenever I have a long red bar or a long green bar, I look at that bar and understand that that's in control. What you're looking for is what's in control, what's dominating that chart, right? And you realize that this week when we dropped, well, we traded in that week for this period of time. So if you look at that, well, that bar sure looks like it was in control to me. We stayed in that week for almost, what, a year? We're almost there. Yeah, since May. It was a year. And then you come up here and go, well, how long have we been out of that bar? Well, we've been out here. Now, there's probably a way to change the color on this so we don't have the same color. And let's go to style. There we go. Then we'll make this green. Green because it's going up. Yeah, I think that kind of helps. Okay. So, and the background we can change too, and we'll change that to green. Oh, there we go. Perfect. So you could see down here how this control bar was there and now how this is green up here, right? So you could see that we're just starting to get out of the shadow of this control bar and we've just made a higher high. Well, Walmart's lifting retail. So then you start running through some of the other names and you'll start seeing a pattern. Now, the names that I've been focused on the most, and we did trade ON, but I want to make this really clear. I don't think that this trade's over, far from it, right? When new companies come out like this, they go for a ride, right? And that's all this is doing. Let's just go through and let me just show you this. Whenever you have a new IPO, and you're going to want to remember this, and I know some people take notes when I give these, I would suggest you mark some of this stuff down and then you go back and rewatch it and just write like a little lesson. A lot of people do that, and the people that do that seem to be getting further ahead faster, right? And that's always the goal, right? How can we get there faster but effectively? So you watch how you're holding this area right in here, okay? Look at that opening price. So one key thing you always want to do, you always want to mark the opening price of every IPO, every single one, right? Even if it goes back a year or two, it doesn't matter, because you can see the levels here and how once you break it, that's it. I'll show you a glaring one that I did really well with shorting. And now you can see how you're fighting that here. So what is that telling us? Well, it's just telling us that our major resistance is 35.21. It's not telling us that we're down. I'm going to give one more lesson and then we're going to get back to it. So this is Rivian. And these to me were the easiest trades in the world. Now they were easy to me because I've been trading for a while and I was trading through 2000. So I remember this pattern and it works perfectly. So when you have these high flying IPOs and they start breaking that opening price, you have to understand that that opening price is when the allocations of the IPOs go out, right? So you're a fund, you wanted 1 million shares. Goldman only gave you 500,000 shares, right? In your allocation, when the company goes public, there's obviously not infinite shares or else companies would have infinite valuations. I mean, that just makes sense, right? So if you look at that and go, okay, well, I didn't get what I wanted, so now I got to go in the open market and buy. All right, so I got 500, I wanted 1 million, go buy 3 or 250 at the open so that we can just average dollar cost average into this and I'll play with 250, right? So they do that, then they're feeling good and they're realizing how smart they are. And then it comes back down, and then they're realizing that maybe they're not smart. So now they have a decision to make, right? And that's always important to watch. Do they add at that opening price where they bought more, or do they sell? Once this broke, that was it. You could tell. It's not just the EV companies. It doesn't matter what type of company it is. If you take a look at Coin, you'll see the same exact thing, but you'll see it even clearer. In other words, if you looked at Coin after the first week and just said, nobody wants to own this. If you just looked at the opening price and said, nobody wants to own this, this is a no-brainer. There's no way that I'm going to stay in this trade, right? And you just use that as your demarcation line before you would even get into it, you avoided a 90% loss, just off of something as simplistic as that. So I thought that was an important lesson. That's why I wanted to get it out there. Opening prices of IPOs, right? Opening prices of IPOs. I can't stress it enough. Look at this one. We just traded this and did fairly well with it. So this is Kava. Now, I'm not going to get into all this, but that's the opening price, right? So you can see how we're acting at that opening price. This actually did something down here that triggered that actually right this bar is where I bought it. And I did fairly well with the trade, but I'm constantly monitoring what's going on with that opening price. So I'm seeing it rejection, flips to what? Support, rejection, flips, battles, retests, goes. And then what happens? Well, we got to the top of this. Let's make this a 5 real quick. But then we got to the top of this, and then what happened, right? Then we have that rejection. And this is again, as far as an exit, I'll just give you the exit because it's very simple. You get to the top, you form a doji, right? And you can tell because this is where the algos and all the high frequency guys are. And then as soon as you break that doji, boom, that was it. So trade's over. I trimmed, moved the stop up, did well. Look at the retest the next day on Friday at 9:30. Same exact level, same super reheated. What happened after we broke the open there? Start marking the open on your charts, guys, especially with new IPOs. You might want to watch that part a couple times, especially for you short-term traders. Okay, so now you're saying, okay, that's great, but back to our regularly scheduled program. So now you look at XLY and go, well, that's breaking out. Okay, well, if XLY is breaking out, XLF is participating, Walmart's breaking out, JP Morgan's breaking out. Well, how's tech doing? Okay. Oh, it's at an all-time high. Okay. So now Apple's at an all-time high. Microsoft's breaking out, right? Where do you think the market's going? Okay. So when you start connecting all this, get rid of the noise. And this is why I keep saying with FinTwit or YouTube, even if you find me distracting, focus on what's actually happening. And the reason I'm so adamant about that is I've done a couple videos on this. You're not going to see this again in your lifetime, probably. It's very rare that you're going to see technology that is going to change the way that corporations spend money. And that makes it very different than .com, right? There's a reason names like Oracle are doing what they're doing. Now, these names are at the top of their list, and I want to show you this because this is fascinating. Make sure you get the newsletter today, too. There'll be a link that I will post in the comments, and it's in the description as well. There'll be 20 charts that you're going to really want to focus on as to what's going on right now. But if you take a look at this level and you see how we're acting right in here, we flipped an upper channel on Oracle. This thing, when you flip these upper channels, these things are off to the races. Okay, so this is substantive, and I would not rule this out. Okay, when you start to see this, this is how massive exponential moves start. They flip upper channels on weekly charts. Keep that in mind, and I would have Oracle on my list. Now, we understand where we are at the NASDAQ. We understand what's going on in the world, but I think that this is absolutely fascinating. So this is FedWatch Tool. You can go to CME.com. You can watch this for yourself. It's free. And this is roughly where we are with interest rates. And where I'm showing you is December, end of the year. Okay. So here we are, and they're saying, oh, well, there's a 48% chance that rates are going to be here in December. And there's like a 5% chance over here. Okay. And then they're saying, oh, well, there's a 37% chance we're going to be over here. And there's an 8% chance that we're going to be lower. So this is what I want you to remember before I show you the next graph. 37.7, right? Which gets you at 5 to 5.25, 475 to here. Total those together, you get roughly 45%. Let's go look at July for a second, which is happening in 30 days. Okay, there is a 75% chance that you're going to be here, 74.4, and there's a 25% chance that they're going to leave rates alone. So the probability of a rate hike, okay, is substantial. It's 3 times greater than them leaving rates where they are, right? 25 times 3, it's not that hard to figure out how I got there. Okay, so now we know that. Well, that's weird. Okay, so you're telling me they're going to raise rates, and then after they raise rates, within, by the end of the year, they're going to cut rates. So we're going to raise them to cut them, right? Because what we're going to do is going to make things so bad, we're going to have to cut rates to stimulate the economy. Okay, it's absolute madness if you think about it. Like, I can't tell you the last time I saw things this out of whack. Now, I'm just going to give you a quick blurb. I'm not the only one that thinks this. Whether you like Larry Summers or not, it's really irrelevant. The guy is extremely smart and understands the Fed. And he was saying the same thing. He's like, this is a little bit confusing. He's trying to be diplomatic as they are, right? But he's saying that this meeting was like, maybe there's some politics, maybe there's something going on here. So when you look at these words, former Treasury Secretary report said Federal Reserve policymakers appear settled on an inconsistent set of actions this week. That's an understatement. One reporter actually said, it's like you're telling me to join the gym because I need to lose weight, but don't exercise right now. Exercise in a month. It was kind of funny. I actually laughed, but maybe that's because I'm a little bit of a finance nerd. I found the Fed action a little bit confusing, Summers told Bloomberg. He also noted that while there were arguments for not hiking rates on Wednesdays, those wouldn't be consistent with adding 2 rate increases to the outlook for the rest of the year. Well, this is what I think is happening, but let's just follow this. This meeting felt like it was driven much by the internal political dynamics of the Fed as by any consistent adhering reading on the economic situation. And that was a bit disturbing. And I think that's what's happening. I think, and let's be honest about this. Politics always plays a part. Doesn't matter if it's Biden or Reagan. It always plays a part. So let's just deal with it. It is what it is. But I do agree with him that this was probably the most confusing Fed statement that we've had in 2 years. Now, why this is important is because we're hitting a point on the indexes, which we're about to get into in a moment, that are affecting they're going to affect the markets, right? And I'm going to explain that. But I have this uncertainty that we're going to figure out in the next 30 days looming over our head now. And if we take a look at December, you're telling me that we're probably going to cut rates, but July, if you take a look right here, as we just went over, we're going to raise rates first, and then you just take a look at September really quickly. Okay, by September, we're definitely going to raise rates, and we might even have raised twice by September. But then in November, we might have to cut. And then by December, well, we might cut, two or three times by then. It's absolutely madness the way that they're explaining their actions right now. Now, before we get into some other names, let's take a look at what's going on with the internals of the indexes. We're seeing one of the more extreme readings right now in smart money versus dumb money. And for those that are new, we don't refer to it as smart money, and we certainly don't refer to this as dumb money. We refer to this as institutional money, and we refer to this as retail money. Now, we're seeing one of the more extreme spreads, and before we get into that spread, what we're seeing is over exuberance on retail. And then at the same time, we're seeing extreme pessimism on the institutional side. Now, before we dig into this, let's talk about this extreme pessimism, how long it's been there, and how they've done with that pessimism. Now, this, for those that are new, is the small spec index position. And what this does is this shows speculator positions, smaller speculators, under $20 billion. Use that as your guide. And where they are in regards to their investments. Are they net long or net short? Now, there are different ways to have smart money be pessimistic or optimistic, right? There's different ways for institutions to do that. But as a guide, historically, if we take a look at what they've been doing and we look at the circle, we can see that they have been net short since about October. Small speculators, net short since October. Now, to put this in perspective, again, for those that haven't seen this graph, you can see that this is historically, if we go back to the data, which goes back to 87, this is historically the most net short that small speculators have ever been. We keep hearing this overbought mentality. I'm not saying that there aren't things that we're going to talk about that clearly show that we are overbought. I'm saying in the long term, if you're looking historically at where we've been over 40 years, this is a massive net short position that's either going to pay down the line if they're going to hold it, or they are massively out of position. Now, if we go back to the smart money, dumb money confidence, and the red is the quote, dumb money, or as we refer to it, retail. And we're just going to draw a line straight across just so we can see this level and how many times since 2004 we've been above that level. And you can see it's pretty rare. I'm not looking at smart money. I'm looking at dumb money or retail. How many times were we really above here? And there's a reason why I'm looking at it this way. So here we are, and we can mark these spots, right? And we can see this disparity between here and here. And how many times do we have that kind of level that we're seeing that? Well, we have this spot in 2021 where we can see that smart money did not think that the market was going to go up, but we have an over invested in dumb money. And then you can see that again in 2019. Now, I'm showing these for a reason, and we're going to zoom into these specific areas. You can see we're above here, but we're not really having the same disparity. And then if we come here, we're seeing a disparity that's very similar, right? And this would put us around 2011. So we have a 2011 date where we can see that disparity. Even though we're over here, there's really not the same disparity. So we have 2011 that we could take a look at. We have 2019 we could take a look at. And we have 2021 when the disparity is the greatest between dumb money being overzealous and smart money or institutions being overly pessimistic. Now, for our sake, we're going to zoom in just so we can see what happened between 2010 and 2000. Here we are, overzealous, overly pessimistic. And then from there, what we would do is just say, okay, well, what happened over that period of time before they reverted? Well, if we take that mark and we say it's right here, you could argue that we did nothing but go up for about 6 months. Now, at the same time, I think it's important to note that when, quote, smart money or institutions are at the high and retail is at the low, that we usually underperform. So the reason I'm showing you this is we're going to look at the spread. And the reason I'm showing it this way is because you can see the differentiation in the spread where this gives us a period of underperformance, doesn't it? Right? Where if the retail or dumb money is overzealous, while the institutions are behind, right? What is that doing for us? Well, that is giving us a clear signal that we're going higher, where this is giving us underperformance. So while the spread between is greater when we have an overzealous institution versus an overzealous retail, we can see the differentiation. There's a reason for that, and we'll get into it. So what we're doing is just zooming in on certain time frames to see what happened. Here's January 2019. We have an overzealous institution. We have an underimpressed retail presence, and we can see what happens, complete underperformance, right? And then you can start to see that reversal. And what happens when we get that reversal? We start to see outperformance. Once again, outperformance before what happened? The pandemic. So we can see that this is actually working, but it's the disparity that makes the difference. It's the disparity between these two. We need one overbought, one oversold, and the wider the disparity, the greater the magnitude of the move. We're going to explain why this is. Now, if we zoom in here between October to April, right, and we see how overzealous we were on the quote dumb money or retail side versus how underwhelmed institutions were, and then you look at where the cross happened, it pretty much called the top of the market, right? This inversion called the top of the market, but look how long we stayed overbought. And look what happened to the market during that period in time. Now, this is the smart money or institution, dumb money, retail confidence spread. This is the spread between the two numbers. And what you're seeing is that when you're up here, that would mean that we have an overzealous institutional. And if we have this, we have an overzealous retail. Okay, so just keep that in mind. Now, if we take a look at this data, and let's just clean this off for a second, and let's just go out and say 20 years just to start, and you can see the marks. But let's just go out here and just drop a line, just so we can see where we're at and how far this really is. Now, by far, we're going back 20 years, and during that 20 years, you can see maybe we're down here 6 or 7 times. So every 18 months, we might be down here, right? That's one way of looking at this. Now, what I'm going to point out is just over this 5-year period, and we went through how this worked during 2012, but I think that this is more pertinent now because the times are a little bit different, and they're different because of interest rates and some other things. But look how long that spread lasted for, where institutions just said, yep, we're not buying. We're not throwing the towel in. And why was that? Well, if you look at what the investment banks were saying, they were talking about this great recession. There was a tremendous amount of uncertainty. We didn't know how things were going to act, right? We just really didn't have a clue. And then what happened from this uncertainty? Well, we just kept going higher and higher until what happened? Until you get up here and you get the complete inversion, right? And we're supposed to be excited when institutions are putting money to work. Well, this only works so much. But what this is telling you is when they stepped in and with quote smart money, you're looking at ETFs as well. So they get inflows and they have to put that money to work. Now, the one thing that we're heading towards right now is something very similar where we're just starting this disparity. And I'm not going to get into the short term and what I think is going to happen because I'm going to discuss in a bit here that I do think that there's the possibility of a pullback. And there's a lot of data to support that. That's a pullback. That's not a crash. That's not taking out the lows. Those days are behind us, whether or not people want to believe that. But what is important is understanding where we're at. Now, move this up so we can see the dates here. So now, if we're looking at this, and let's just say, devil's advocate, that this is just starting. It looks very similar to something like this where they didn't believe it, then we came up a little bit and then pulled back. Maybe it's a little more aggressive, but we're also more net short here. Remember the small speculation index? We're more net short here, the S&P, than we were during a pandemic. Does that make any sense to anybody out there? If it does, please comment below and explain to me why we should be more net short now than we were during a pandemic when people were literally falling over. Okay, so it's just, you had so much uncertainty here and we're more net short here. This is what happens at the end of every bear market, and this bear market ended a while ago, but you get a group of people that just refuse to believe, it's ego driven, and they just absolutely refuse to believe that they missed it. And those people go on for the next 20 years talking about why you need to buy physical gold. So we have to look at what's happening here, right? Not what we think is going to happen, but what's actually happening. What's happening is we're getting one of the greatest disparities that we've gotten. During these disparities, when we're down here over that period of time going all the way back to the great financial crisis, this historically long-term has been a spot where you would want to get involved, where you would want to buy. Now, why is it better here than here? Well, this is really simple. You never really run out of retail capital, right? There's always someone else in retail that is going to invest and put money in. You run out of institutional capital. And institutional capital moves together, right, in tandem. They're all chasing the same shiny object, right, performance. So when one jumps in, they all jump in. And that's what you tend to see here. People will say, well, this marked the bottom. If you get really careful and look at it, it doesn't. Right? What it does usually is it marks like a top-ish kind of area because they jump in a little early. But that's what institutions do because they have a different time frame. That's how I learned to trade. It's why sometimes people, even in the alpha chasers community, I will say the words, I'm early, because I know that I'm watching a thesis unfold and I just know that my timing might be off on when I put the trade on, especially if I'm looking longer term. Anyway, you can see your curvature here as what happened. See how the spread gets worse, right? Where retail believes more than institutions. And what happens the whole time that we're rolling here as institutions get out and out of the market? Well, we're going higher the whole time that they're lightening their positions. Their net position, no matter how you want to look at it, is lightening. And we just even went through small speculators there and you saw it. All right, so we have this and we know that we're rolling here. Well, what happens when institutions realize that they've gone too far? What do? Well, they buy stock, okay? That's why the spread down here is so much more interesting than when it's up here. If this was up here, that would be a concern of mine because they would be wanting to get out to lock in their profits. They have no profits to lock in. Go look at hedge fund performance. I think they're up 5% on the year, right? Because they're so hedged. And that's not going to go well when we do window dressing, which we're going to address. But look what happens when they make a U-turn. So you have a U-turn right here, right? You can see this right here. You have a U-turn, okay? And what they're doing there is they're basically saying, you know what? We might be on the wrong side of this. They get together, they have a meeting, and then all of a sudden you start pushing, right? And look at the higher highs. And what do those higher highs tell you? Oh, well, that's a peak. We have the exact opposite setup going here. Comment below on this if this is too in-depth. I got a lot of comments to be more specific. A lot of people at first were telling me that I need to go back to some of the basic stuff, but I'd like to give some of the detail that I actually do and some of the research that I do so that you can utilize it yourself and you can see if there's value in it. Obviously, I'm going to think that there is value in it, but I would watch this very carefully, and this is definitely something on my radar, and it's been a good barometer if you go back over a period of time. If you took the time to look at this data and go back over it over 20 years, you'll see very clearly that this has marked significant bottoms in the market, and we're there, like it or not. And it's very clear that as this drops and the spread widens towards the favor of retail, right, being more pot committed than we're seeing institutions, the market's going higher. So we can say anything we want, but price pays, everything else is conversation. Now, short term, there are some signs that I'm seeing of a pullback. Now, I'm going to show one piece of data that was going to tell us that there's probably going to be a pullback. And we're going to go back to about 2011 here. And I think that's a good spot to go because we're coming out of the great financial crisis and we can see how we acted during that period of time. And what I want to just point out is this is a shorter or medium term indicator. In other words, I expect this to trigger within 30 days, or I should say it has the probability to trigger within 30 days. So I have found 9 spots where this has transpired. If I come all the way to where we are now on the weekly, on the RSI on the bottom, you will note this line, roughly 80. And you will see all these spots where we have come in and we have tested. And every single one of these is hitting 80. Now, why is that important? Well, usually standardized, you're going to see that, you're going to try to see that 70 level as overbought. We're going to shrink that down so that you can focus on it for a moment, and then we'll drill into it from there. But if you look at these levels and you go through them, there have been 9 times. So when we get to an 80 RSI on the NASDAQ weekly, we've gotten there 9 times since 2011. 8 of the 9 times we have dropped. Let me be clear. Since 2011, we have seen 80 RSI 9 times. 8 of those 9 times, the market has dropped lower in 30 days. Now, when I say lower in 30 days, I'm giving us a range. I'm not saying on the 30th day we're going to be lower. I'm saying within day 1 to day 30, after we hit an 80, there is a pullback. So in other words, we could hit 80 on this day, and day 1, we could drop. And then you could go to day 30, and then by day 30, you could actually be up over where you were day 1. But in between here, you had a drop. Just like here, you could have triggered, and day 1, nothing. But day 30, you could be down. So what I'm doing is giving you a range. I'm not giving you a time, but I'm saying within the next 30 days, 8 of 9 times since 2011, the market has dropped. Now, how much has that market dropped? The average drop is 4.14%, meaning once this happens, 8 of 9 times, we've dropped an average of 4.14%. Now, in every single case, as you can tell, we eventually go higher. That's completely irrelevant because that's a question of time. What I'm referring to is this is intermediate. So we're looking at that 30-day window. I'm not giving you 3 months from now, 6 months from now, a year from now. What I'm doing is I'm quantifying this data on a scenario that we currently have, extrapolating out scenarios where this has happened before, looking at the average. Now, if something has happened 8 of 9 times in the market in 30 days and averages this drop, I have to assume something like that is out there, and we have the possibility of that. So I would watch this again and how I explain that, because there's a lot of detail in there, and you're really not going to get that anywhere else. Very few people out there are actually doing their own analyzation and doing their own research. Most are just regurgitating what someone else said. So I always find it helpful to understand what these indicators are. And then when you do that, you're able to utilize the data in a way that might be more efficient for the way that you trade. Now, we keep hearing this term overbought, and on a short term and intermediate term, yes, we are. I just want to point something out on a long-term situation. On the month on the NASDAQ, I'm going back 20 years. We're back over that 50 line, period. Okay, it's irrefutable. That's a pretty classic long-term buy signal, guys, when that happens, okay? It is extremely rare for this to happen. Do you know how rare that is for this to happen? Okay, in 20 years, look how many times it's happened, right? So you have it happening once here in 2009, which marked the bottom of the NASDAQ, and then we had it happen one other time over here, September 3rd, which marked the bottom of the NASDAQ, and now we had it happen here. Now, statistically speaking, and I'm a numbers junkie, which you guys are probably picking up, statistically speaking, you need 30 data points in order to have something of statistical significance, right? We have 3. This is all I have. I can only give you what we have. So is that statistically significant? The answer is no. But it's a very interesting coincidence that I would not ignore, and I certainly am not ignoring it from my long-term thesis. You've heard me mention several times that I personally think that we're in an area where we're going to run for a period of time. Now, I will say this channel up here in this line is obviously eventually going to be an issue. There's no question about that when you start getting long-term, but we are very far away from that. And we could very simply grind higher and ride it like we did, over here. But, you're looking at a level where you're looking at 16, 17% before we even have to look at something like that, right? Which is substantive from where we are. And my thought is that there's going to be some kind of pullback consolidation, which will give this more time. And it's quite possible you even flip something like this. But you are far, far from long-term overbought. And I'm going to be real clear. Once you get overbought, if you go back and take a look at the past 10 years, once you get the quote overbought, look at the average time frame that you're quote overbought, right? And we're supposed to be discussing that as if it's a bad thing. Okay. That was almost 3 years of being, quote, overbought, right? And you come here and take a look at 16 to here, okay? That was 2 years. And this last time was probably close to about a year and a half. So that can go on for a while, and we haven't even triggered that yet. So just something to keep in mind. You can be overbought for a very long period of time. Long term, it's very hard to bet against this. Take a look at this as well. Now, in front of us is the NASDAQ 100 stocks above the 200-day moving average, right? And what you're going to see is this. And I'm just going to show you something. So this is percentage of stocks above the 200-day moving average. So you're going to just come to the top of this area right here in 210, which was your peak, okay? And that was roughly, I don't know how you would have gotten to 100, but it seems kind of crazy that every stock in the NASDAQ 100 was above its 200-day moving average. Maybe that's a sign of froth if we ever see that again. But here we are, right? And I just want to point out this particular window that we circled that we just recently popped back in. So if we take a look here from May 20th, and we look at that and go from to November 2021. Well, when we were in the window that I just drew, what happened? Well, we had one of the greatest runs we've ever had by popping back over. So under and over is statistically significant. Why is it? Because of the amount of data points that you have in here. Now take a look at this. I would also take note when we're popping in this for the first time, just as those two examples I just gave you. But you can screenshot this. You can go look it up yourself, NDTH. And this will be on, I'm using TradingView, but I'm sure other systems, I know that, I think TC2000 has this too. It doesn't matter what system you use. I'm sure that others have it. But you're looking at NASDAQ 100 stocks above the 200-day moving average on a percentage basis. Now, I've given you reasons why long-term we look solid. Right? Short term, why I think there's a pullback besides what we went over on the RSI, in front of us is the stocks above the 20-day moving average, S&P 500. So different index now. S5TW is the symbol via TradingView. Now, see these levels? Every time we get up here, we start to see something like this, start to see that unraveling. Now, let's be realistic about this. 90% of all stocks are now above their 20-day moving average. How realistic is that we don't see some kind of pullback if we look at this market, right? Historically, if you look at this, when you get to this level, this is an overbought level, okay? And it's a 20-day moving average. So this is a short-term indicator. Now, if you were going to get under a 20-day moving average, does that sound like something that might happen within 20 days or less, right? Okay, so that makes it a short-term indicator, right? If it was the 200-day, which it is not, the 200-day looks excellent. Now, I'll show you that right now. This looks excellent and is far from overbought, right? So again, long-term, extremely healthy. Short-term, maybe we got a little bit ahead of ourselves and maybe a pullback is out there. I personally think we see one in 30 days. I think we see one before the next Fed meeting. That's my opinion. But no one's going to ring a bell and tell me exactly when it's going to happen. But this does make me stand up and say, okay, well, I need to pay attention to this because quite frankly, this means that 450 stocks are above their 200-day moving average and there's only 50 left. So when you get to those levels and you start looking at those extremes, okay, they can be warning signs. Now, there's also other warning signs. When the market's going up, like it was here, right, and you're unable to hit new highs. Well, we're still able to hit new highs. And I want to point something out. Again, this is a short-term indicator, remember, 20 days. And you're seeing a change here, okay? Look at this. Now, obviously, you broke down here and you retested that level. But even if you use that level right here, you see how your slope is up long-term from going all the way back to September on the percentage of stocks that is staying on pullbacks, that is staying above on pullbacks, right? I like this better because it has more data points, but nonetheless. And that is the exact opposite of what you see in a topping pattern that happened here, right? Which marked the high of the market, okay? This is the exact opposite pattern where we're getting stronger and more stocks are staying above their 20 versus what was happening here. But what we're going to do is we're going to look at these marks and then we're going to look at the S&P and see what happened. Now, above us, we have those dates marked off with arrows. And what I want to do is I'm going to mark them off and show you how I do this. So here's the first one, right? Here's our reading, 89 roughly. We're fully aware that we have 50 stocks that are below, and we know that this is a trough reading. If we see this line right here and we see how it connects down here, we drop that arrow. Now, I'm going to point this out. There's a lot of other factors that go into these moves, but this is a 20-day moving average. So for our purposes, this is a short-term indicator, and that's how we're using this. So from here to here down, I believe was 12%. And they're not all going to do that because they have other things behind them when it happens. But they're telling me in 30 days, it was roughly 11.45, roughly 12% on that move. Now, that's important, but the most important date is going to be the one that happened the closest to us, just FYI. But if we come across and we mark these dates and we just take a look at the next one, okay, well, that certainly marked the top. So now we have two of those data points that mark the top. Okay, we can see that pretty clearly, right? So what we're seeing is a correlation, right? And is it statistically significant? I think you hung out here enough that one could make the argument that it is. Even though you have 6 times, you've been up here for days, right? There's days up here. So there's actual days that you could calculate, and it would get you those 30 data points. But I thought this was interesting. So you come here, and let's put it on when it starts. So you start right here. Hold on a second. There we go. Now let's go when it starts, which is right here. So it starts here. Then we trade up a little bit, but this doesn't go higher. So you get a divergence, right? And the divergence, and we'll blow this up a little bit down here so that we can see it. So you get this divergence, right? So we actually trade up a little bit why this goes sideways here. And what does that do for us? Well, besides confuse the living heck out of us, it sets us up to kind of crack down, right? Then you go forward, lift, come through this, and now look at where the next one is, right here. Now this is important because we still didn't drop, but what did we do? We went sideways, okay? So can you make the argument that you have a negative divergence here? Not really, because we didn't roll yet. You can always get more of this, right? You could get to 92 or something up here, okay? I don't know, at this case we had a 99. I don't know that that's realistic for us to see that again. But, and you remember that's the pandemic that we had something like that. So I don't think we're going to see that again anytime soon. So we really don't have anywhere to go but to start rolling. So this is why I think, another data point as why I think in the next 30 days between what I'm seeing in the internals in the S&P and what I'm seeing in the internals in the NASDAQ that we've gone over, short term within 30 days, it does seem like the probability of some kind of pullback out there is greater than not. And just to reiterate, this is the long-term trend up here, up top, and this is your 200-day moving average in stocks above the 200-day moving average. And I want to be really clear about this. This is trading perfectly in tandem. So when people say the breadth of the market's an issue, okay, every time you flip this 50, we went over this 2 videos ago, every single time you flip this 50, it's a buy signal to some extent. It's one data point, but it does rate as a buy signal. And it did it again right here. And it rated as that. It's STH and you can follow it. Please comment on this and let me know if this is too in-depth, if it's too much information. Right? I know some of this stuff you can get buried in the details. And I know I'm comparing 2 separate things where I'm comparing what's going to happen in the short term versus the long-term outlook. It's very important to get that distinction, so that when you see the market pull back, you understand that it's actually a pullback to revert to a more neutral stance than to revert to, quote, a crash, or when people start tweeting or the YouTube videos of stock market crash, we can take advantage of their, for lack of a better word, ignorance without them actually understanding what's really going on out there. And I'll give you another example. Now, this is the SOXL. And this is something that we talked about in great detail. We actually put a trade on in this at like 14 bucks, and now we're at $25. So obviously we've done quite well with it. Now, I got to a level here where I said, oh, you should trim some. I didn't think historically that we had a problem. I didn't think technically we had a problem. I thought we had a problem with the move. In other words, I was looking at these bands, and this band that I'm showing you here, these are standard deviations. So this is a 3rd standard deviation, 2nd standard deviation, 1st standard deviation, and a 20 SMA. And the purpose I'm getting at here is once you hit one of these bands, the volatility and the probability of you staying in this range is like 99.7%. So, and that's what I'm trying to point out. some of the statistics that we're going over, and that's why I'm explaining it through this example, because this is a real life example. We got here. Everyone's looking at this chart and cheering. Well, 3 weeks later, that's great. You're up $1.50, $2. But here, after being up 8 or 9 points, why risk that you come here, undercut here, right? And then make a new low. Like, you don't know what's going to happen, right? You're just managing probabilities. That's all we're doing. So you have to understand that when you're at this third standard deviation, you have a 99.7% chance of staying in that range. Well, if that's the fact, and I'm up here, why am I going crazy and hog wild up here? I should be protecting capital, right? Not increasing the bet. Now we could make the argument that on these pullbacks, under a second standard deviation, there might be places to add, but we can do that in another video. But that's why I'm pointing things like this out with the S&P 20 days. Now, you don't have to use the Bollinger Bands for there. I mean, they're just going to show you a median line, but I'm just going to leave them in because it's kind of interesting to see how you trade at one standard deviation or a second standard deviation, and then what happens when you get there, right? The chances of you hitting a third standard deviation on this are so insane that when you do it, you almost just want to print stock. I mean, it's kind of crazy, to be quite honest with you. Again, I could do another video, but comment on this. Let me know if it's too much. I just want you to understand that this is what you're looking for. You're looking for anomalies. You're looking for things that have happened in the past that are at extreme readings, and then you're looking at what the market does after that. That's what we're doing. We're not predicting anything. We're analyzing and assessing a probability to it. During any boom-bust cycle, you're going to see winners and losers. Winners are always going to outpace substantially. NVIDIA is going to be the winner. That is becoming increasingly clear with what we saw from the AMD conference this week and the action. What I want to just point out here with NVIDIA is this is very simple. This was the little pullback that we got. We hardly got any pullback in the name, okay? Hardly zero. If you look at the 50% mark on that earnings call, that would have taken us to 342. We couldn't even get there. And that's an important distinction, okay? It is becoming increasingly clear that NVIDIA is the 800-pound gorilla and nobody is very close to them. Even here, that would have taken you right to that line, as you can see. Now, AMD's conference call showed one thing, or their meeting showed one thing. They are nowhere near as close to developing something that is going to compete directly with NVIDIA. Not even close. So we can talk about the production and some of the other stuff, but what we're starting to see is a pattern here where we're seeing massive dumping based upon the expectations that they thought were going to exist. You will have winners and losers here. That does not mean that a rising tide will not lift all boats, but some boats are going to go a little faster. That's it.